Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The tech industry has some giants that I think still have a ton of growth potential long term. The three that I'm going to cover today are Alphabet, Spotify, and Taiwan Semiconductor. I think these companies still have a lot of tailwinds behind them, and that could make them great stocks to own for the long term. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. If you like this video, check out my newsletter, Asymmetric Investing. I have a link to that in the show notes. And I'm going to start with Alphabet and just show the trailing numbers for this company because their growth has been tremendous. This is the revenue and net income chart. You can see that over the last 10 years, the company has gone from $54 billion in revenue to nearly $300 billion. And now they're generating more in net income than they were generating in revenue a year ago. Just tremendous results. There are a number of tailwinds behind Alphabet as a company. Not only do you have the core Google search business, I think that's going to continue to be really strong, but you have growth markets like YouTube, where you're watching here. I think that's going to continue to be one of the strengths in streaming. Those results will likely ebb and flow because there is brand advertising there, but I think that is going to be a huge strength for the company. You have optionality in a business like Waymo. And then, of course, you have artificial intelligence. Not only is Alphabet playing in artificial intelligence in the cloud, but they have their own AI products and services as well. So that's going to be a tailwind for the company. This may not be the explosive growth company that 5x's revenue over the next 10 years, but I do think that this is going to be a solid growth company, growing probably in the double digits over the next 5 to 10 years. Despite the fact that this is one of the biggest companies in the world, there's still a lot of tailwinds behind Alphabet. And I think for investors, that is just a great reason to buy the stock. For Spotify, I'm going to show a couple of different things. This is the company's revenue and net income. You can see that Spotify is losing money on a net income basis. It has typically been positive on a free cash flow basis, but what pushes it to a negative number is stock-based compensation. The revenue has grown from about 2 billion euros in 2016 to over 12 billion euros today. And what I want to highlight here is that I think the momentum is going to continue. This is the company's most recent earnings report. And what I thought was incredibly impressive was the 27% year over year monthly active user growth number and the premium subscriber number growth of 17%. Ad-supported subscribers grew 34%. This ad-supported side of the business is really the top of the funnel. These are customers that aren't necessarily paying to use the service, but Spotify is able to generate revenue by putting ads in between songs or in podcasts. The really long-term bullish thesis for Spotify is that they're going to turn that advertising business into something that looks a little bit like YouTube and might be both much larger from a revenue perspective and higher margin. So I think this is a company that can continue to grow really significantly. You can see the user numbers are growing like crazy. Revenue not quite growing as much, but as some of these customers move from ad-supported tiers to premium, that's going to be something that's going to improve over time. So I think this is another giant, big name in audio, but I think they have a lot of tailwinds behind them. The final one is Taiwan Semiconductor. Taiwan Semiconductor makes most of the chips that powers artificial intelligence, smartphones, most high-end goods, and it's not a brand that you're probably going to see in a lot of places, but it's a very, very critical company for making technology work today. And you can see that their business is just phenomenal, has grown more than 4x over the last 10 years. And look at this net income margin. This is what I think is always so impressive about this business. Their net income margin is nearly 50%. That's just an incredibly high margin, especially for a business that's not a software business. This is a hardware business. They invest tens of billions of dollars building out fabrication facilities, but then they're able to charge a premium because they're the company making the most advanced chips in the world. That's why we see these kinds of margins. And I just don't see demand for these kind of products going away anytime soon. We have seen the demand for artificial intelligence chips. We now have a new iPhone coming from Apple. There's going to be ebbs and flows in the chip business like there always is. But long term, this is going to be a company that it's going to continue to grow because it's on the bleeding edge of chips. And for the foreseeable future, there's really no one else that can match their technology and their manufacturing capabilities. Alphabet, Spotify, and Taiwan Semiconductor are already relatively big companies, but that doesn't mean that they can't continue to grow and build on the success that they've already had. And that's what I think we're going to see over the next decade. All three have a dominant position in their specific markets, and I think we could see both revenue growth and margin expansion. And I just don't see any competitors coming into these spaces and knocking them off either. But what do you think about these tech giants? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.